Everybody, TJM, and welcome to week 20. This is Into the Fire edition part 2. If you didn't catch a very kind of live and dynamic kind of piece from obviously kind of last week. So we're going to be covering a few things today. Obviously, US-China is going to be kind of the key focus. I'll also be sharing some kind of interesting outtakes just to kind of mix it up as we always do here on Macro Monday. Always looking for profitable opportunities in regards to kind of the big traders lunch that we had on Friday and some kind of the takeaways that kind of came out to that. And then, of course, we will actually also be joined by a colleague of mine, Forrest Mao, out of the greater kind of China offices. And that will be also good to kind of get a little bit of local kind of color in regards to potentially how things are being seen, because obviously the filter we tend to get tends to be very kind of pro-West, or at least from a Western kind of driven kind of perspective. As always, everything we cover is solely views and opinions. These are not trading nor investment recommendations. So obviously it all kind of kicked off from this one tweet 2 Sundays back, which was early Monday, Asia, that kind of cascaded everything. This was the initial kind of move that we had, and this here lower chart kind of gives you a little bit of kind of the context of obviously the big kind of sell-off we had in the fourth quarter, massive kind of move up higher, and then a little bit of kind of the pullback that we kind of had. We will definitely be digging into this a lot more, and really interested in getting kind of the Q&A towards kind of the end of the call, where we can discuss kind of things in further and kind of greater detail. Let me take the asset classes and vol, and I'll end with equity last, because that to me, at least at the moment, is quite interesting, as is, of course, let's say CNH and what's happening on the FX side. But to me, at least, the things that are kind of popping up seems to be the dislocations I seem to be noticed on equity as an asset class. So fixed income was actually tighter, obviously, for the week. Not as tight as I initially was expecting us to get, even though we are seeing that significantly move a lot more this Asia morning. Here you can see we closed on Friday at 246 on US 10s. We're now at 243, right? We're 285 from these kind of 288s. JJBs are also tighter. Bunds are not yet kind of open, but you can imagine where they will kind of eventually kind of go to. So that is definitely something more of a move of kind of what I was expecting. But on the commodity side, I mean, probably as you'd expect, risk off. A lot of the softs also hit, potentially expecting on the more China trade deal kind of complications on that. Interesting to note, coffee, net gas getting a little bit of a bid. Gold also a touch. And to be honest, oil has held up pretty well. I mean, that is not really too much of a pullback on oil if you had kind of a risk-off kind of view. On FX, again, not maybe as strong as a week for the US dollar as one would expect. Obviously, dollar-yen makes sense with the yen getting much stronger. Big move there, 104 basis points. Yet, funnily enough, we saw the euro higher. And we also had a few other divergences. If you look at ZAR, 134 basis points last week, and that's on spot alone, so even higher if you take in kind of the carry. This was basically driven into kind of the elections with the incumbents expected to win potentially a bigger majority than what people would have thought as well. So that's quite big. I'd expect quite a bit of that to have a bit of a mean reversion. That was also the second week kind of running. And volatility, at least on the VIX side, amazing plus 25% week. But probably what's even more amazing is we had a basically 16% move lower on Friday off of that. So we think we got to about 20, maybe 22, 23 on the VIX. We have not yet seen a VIX blowout. We are still seeing people, in my opinion, continue to kind of sell volatility as a whole. And you can see here from the last week, basically all red across all major kind of equity indices, and even some of the perifs, funnily enough, in Europe actually out as well. But really kind of dynamic kind of week, so to speak. So the two things, again, going into the equity side of things, I think the stunning thing to me last week was we had just amazing intraday moves on Friday, which at least to someone like me who was super bearish of the way events were unfolding and continue to be, was surprised at how well equities were trading Asia morning. And this was actually right before this client lunch I had to kind of go into. I think at one point we were up maybe even 60, maybe even 80 basis points on S&P futures before getting down to something like 200 basis points from top to peak, from peak to trough, and then ending up kind of rallying kind of later on. And that was basically something that was kind of echoed along a lot of other indices. But it's worth noting a few things. First of all, China equities were up on Friday. Now, a lot of that, as our understanding, was kind of pushed by state kind of controlled institutions were told to buy. What's fascinating is despite the plus 3% move on Friday and stuff like the CSI 300, Shanghai Comp, they still closed down respectively 6.5%, 7.8%. So you can imagine if that support was not there, would easily have been over 10%, low kind of teens. Now, the thing to be cognizant of is we played this game before. We saw it play out in kind of 2015. We covered that in some charts here on Macro Monday. If you go back, I believe it was kind of maybe March-ish, maybe even April-ish. It did not end well at all. You know, talk about something like, off the top of my head, I think it was 45% liquidation from the top. But, you know, I can understand from a Friday saving kind of face perspective, wanted to show China is strong. I totally get that. I just think from a sustainable context, you know, you can't really tame what's untamable, which is really the market at the end of the day. A few other things that really kind of continue to kind of catch my eye from last week. One was SPY futures, again, that continued outperformance, or should I say underperformance in Asia, so i.e. them being sold. And then them kind of coming back and rallying better or doing better in the U.S. kind of European kind of hours. I believe the worst close we had was minus 1.65, which was last Tuesday. Everything else was not even kind of close. Another one that continues to actually be out here in Asia, which is Australian equities and the SPY futures. They continue to outperform not just Asia, but global equities as a whole. I continue to find this pretty mind-blowing, as we were talking about last Monday. I also sent out a piece on this kind of last week. You'd have gotten it if you're on my mailing list. And what's interesting is, at least to me, I just don't see how Australian equities are a long-term safe haven with China being on the ropes the way it is, with CNH weakening and Aussie dollar actually strengthening against the yuan. So this is, again, one of those things that to me is just outstanding. And you can kind of see it here. This here is obviously cash, but only down 40 basis points versus everything else. That's not even kind of close to that. So I guess what I'm saying here is I think that at some point you're going to have a massive, again, assuming that I'm correct about it gets worse before it gets better, I think you're going to have a massive kind of catch-up, and we could easily see this go from the 6,300 to 6,000. But we'll look at a chart or two kind of later that will kind of drill home that kind of point that I have. And of course, the key kind of caveat is I got this completely wrong. China's going to buckle down and play ball with the U.S. For a variety of whatever reasons that you want that to kind of be. I mean, that's kind of the big kind of key risk here. Maybe underestimating the amount of liquidity out there, the amount of support that the central bank is trying or willing to kind of go to. So with that, let's kind of move over to this here was a kind of the piece from Bloomberg that I'm sharing here. This was basically the red tends to indicate the Asia kind of session, with the point being that generally, at least the average plunge, if you will, in E-minis last week from Monday to Thursday, I believe, was an average of about 0.6%, which is a pretty big kind of alpha, so to speak. So again, we're down about 100 basis points as we're recording this and doing this live Asia Monday morning. It'll be very interesting to see how we trade once Europe comes in, once the U.S. kind of comes in. I can see the DAX futures opening up, just down only kind of 9 basis points versus stuff like the Nikkei 50 SPYs, 20 basis points, and Hang Seng futures index at about 50 basis points. And again, we still have to wait about 45 minutes before I think mainland kind of China kind of kicks in. So moving on, cart review, I'm just going to wing through very quickly, not too big kind of changes in regards to overall kind of dollar positioning, but we are way above the December highs. We are at multi-year highs, so just kind of keep that in mind. The only kind of big extreme position seems to be in ruble, which could see a magnificent near-term unwind if we get a big oil sell-off, right? So if we do get a big energy sell-off, that would definitely be something to watch. On that same note, maybe even stuff like CAD and euros continues to also be extreme positioning, at least on a relative one-year max. On the commodities, not too much kind of view, but you can kind of come back to this depending on a few of the other kind of charts that you're looking at. So again, just very briefly from kind of a week ahead perspective, I've kept this very simple. We'll touch on this very shortly. There are a few central banks who will be meeting. You know my viewpoints on most EM kind of banks since the Fed pivoted. There's very much a dovish kind of skew, so I would not be surprised on the likes of ID or even MEX. Less maybe likely there, but definitely Indonesia. If we do get, if not a surprise kind of cut, at least some kind of dovish kind of support from that perspective as the race to the bottom begins when you now all of a sudden do not have a hawkish kind of Fed. And we also have quite a host of Fed speakers. And something else that's worth watching, especially for out here, is this kind of key deadline on bank capital plans in RBNZ. This is definitely something that can affect Australian banks in a very, very big way. Australian banks have about 85% of market share out in New Zealand. And what this basically bank capital plan is, the RBNZ basically saying, well, listen, if you're operating here and you're making money from handing out loans, supporting kind of the real estate, that's all fine and well, but you need to basically accrue and account for that from a margin kind of perspective on capital on your balance sheet, i.e. protection for the next kind of downturn, which is what the RBNZ is thinking. This could again put potential Australian banks under further kind of capital pressure, and we all know that it's just a question of time before they have to kind of keep cutting and lowering kind of their dividends. So this is a structural thing to kind of keep on the radar and to kind of watch. I have no idea in regards to kind of the deadline of, you know, they take that in and when is it actually officially reviewed, when is it implemented, et cetera, et cetera. But it's just one of these things that's floating out there that I don't think a lot of people have on their radar and kind of the potential kind of cascade effects. And it's also worth bearing in mind that, you know, RBNZ moved last month, or should I say, was it last week or 2 weeks ago? I've totally even completely blanked it now. I think it's 2 weeks ago, rather than kind of the RBA, and the next meeting will be the RBA first. So food for thought in regards to kind of potential pressures there. So this was from the Friday lunch, and this is basically the scenarios I have around U.S. kind of China trade deal or war, or however you want to kind of call it. Obviously, as we said last week, there's no doubt it's a surprise. Otherwise, we wouldn't be kind of selling off the way we kind of have been. I think it is very important to think what assumptions do you have. And this is just the point of what's good for maybe the U.S. and China, assuming that's a good, stable kind of trade deal, is perhaps not necessarily good for Trump. This is quite interesting in the sense of you have to remember that Trump is a master showman, you know, hosting The Apprentice for 7-8 years, whatever it was, definitely makes it key that he knows how to kind of control the media in regards to kind of the airwaves. Dems is, you know, the U.S.-China trade talks is one of the few things that the Dems cannot touch Trump, they cannot touch the Republicans on. It's, in fact, one of the few things that they actually agree. And the longer this drags out, the more he commands the airwaves, the more he takes attention away from all the Democratic candidates. I've lost count of how many they are. And the more he can kind of tie it up to potentially 2020, because you have to remember, for him, at the end of the day, it's that combination of being elected next year and, of course, stemming whatever kind of multiple investigations at least are being kind of thrown at him. So I'm not quite convinced that Trump wants a trade deal as much as other people want a trade deal. But that's just kind of a little bit of food for thought in regards to kind of, I think, some of the assumptions that we always come here is that the U.S. and China definitely do want a trade agreement, and that may not be the case, right? So it's just a little bit food for thought just to kind of keep in mind, and to keep in mind that, again, it's a 2020 election year in the U.S. The other thing you should bear in mind is the unintended consequences of making things tough out of the U.S. So, i.e., we're not going to get any respite from a U.S.-China trade deal, means that we have to do more things internally. So it could actually have the inverse consequences of actually increasing the probability of an infrastructure bill, increasing the probability of agricultural kind of subsidies, increasing the probability of, you know, trying to, again, you know, create more new jobs kind of back at home and so on and so forth. So that's also just something else that is worth kind of keeping in mind in all of these things. It's also, lastly, just before I go into the main scenarios, we have to watch, at least for me, it's something that keeps kind of bugging me. A lot of the news flow is very kind of West of the good guys, China of the bad guys, right? From some of the things, if you've read, I'm sure all of you have over the weekend, if China asked the U.S. to change parts of its legal system for a trade deal, I think the U.S. would probably see some issues like that. I'm kind of simplifying it here, but I guess the whole point I'm trying to say is, these are not small issues that they're trying to kind of iron out. What was also very interesting to me in regards to all the kind of news flow over the weekend and articles by Liu He was also, there's this use of the word dignity, right, by China many times, where it's not just about a fair kind of or good deal or so on. It's not just about a deal for them. For them, it's also this, we've arrived, we're part of the table, and we deserve to be here. And they do, right? It's a 3,000 plus civilization, 1.6 billion people, purchasing power parity. It's the biggest in the world, past the U.S. years ago, and it will surpass the U.S. Also just from a normal GDP in the next few decades, right? So this is also a big wanted to just be a global player, where if you look at the world skew today, very much dominated by the U.S. Whether it's the World Bank, whether it's IMF, et cetera, and so on. So I think that's also a big part there, and I'm not quite sure that's getting across to U.S. negotiators, or if they and Trump, or if they don't want to get that across. So let's look at the four main scenarios, not necessarily in order. Let's do 1, let's do 4, let's do 2, and then let's do 3, which is probably the camp I'm starting to kind of gear towards. So I think the first scenario is still this base case scenario of we're going through potentially kind of little volatile breakup here, but we're going to kind of kiss and make up. So this I kind of have at about 50%. And this basically means we get some kind of eventual deal. Now we know basically what happened on Friday is the tariffs went up from 10 to 25%, and China's now been given about 3-4 weeks to come back to the table, get across the line, so to speak. Otherwise, they're basically going to slap tariffs on the remaining plus 325 kind of billion dollars of kind of goods. Now, I think here you basically get a risk off as we're kind of getting potentially more. I don't think enough is priced in personally, in my honest kind of humble opinion. To be honest, I've been very surprised by the lack of kind of follow through, and by this I'm not expecting anything kind of close to kind of the fourth quarter, but I was expecting something close to a -5% kind of cash. 5 to kind of 10% cash week pullback from the S&P rather than just kind of the 2.18. But again, early doors here. We of course still have to wait for the official kind of China response, and does the U.S. respond to that, and so on and so forth, right? But what Trump has also made is he's made it very hard for China to come back and still have face and dignity at the end of the day by just airing out the laundry, kind of, so to speak. But this is still probably likely the case. Whether it's possible over the next 3 to 4 weeks, again, is a whole different thing. I think a 4 is, again, similar, but this is something that basically just drags on like a lot longer. So this is kind of the Brexit version of trade. This is maybe 25%, maybe 20% now, and this is basically just something that tactically would be very tough to play. Maybe structurally you'd want a U.S. bias versus kind of the rest of the world, because again it still ends up being kind of a relative game, so to speak, and there could be a long U.S. Treasury, maybe even a long U.S. dollar kind of bias here. Tough again to see the Fed raising rates in scenarios 1 and 4. And definitely not in 3, but potentially in 2. So 2 is maybe only a 5%, and this is just bearing in mind that anything is always possible. So what happens here is basically we have remarkable kind of turnaround. So here it's like, I'm dead wrong. Trump seals the deal. Xi is happy to put whatever kind of terms forward. It could be that the situation in China is a lot worse than we actually know, potentially, or there's something else kind of in the works. And it could also just be simply Trump moving on to something else and just wanting to sign something, window dress it. And we've seen this many times, right? Where it's not always about substance, so to speak. So I think there's a chance here. I think here you'd see a massive risk on rally, especially in Chinese equities, which I'd be, to be honest, unless this is very, very clear cut, I'd be very, very hesitant to play on the move up. And of course, it would be shorting dollar CNH, bunds, bonds, as well as likes of gold, tactical longs and equities. I mean, everything really pretty much on this page is tactical, so just bear that in mind. So I think the one that I'm more interested in, and this may be some anchoring bias just because we talked about how the market for pretty much this year is ignoring the fact of a potential deal breakup or even just volatility in it, right? So this could be some anchoring and consistency bias on my side. And this here basically could be the scenario where China just plays hardball and goes, you know what? We're tired of this game. Like you guys are not serious. You are trying to usurp our long-term strategic initiative to be self-dependent, as you guys are, to be consumption-driven, to have Chinese goods for Chinese consumers and companies, and not just have cheap goods, but also actually move up kind of the value chain, if you will. And we will not be steamrolled. So I think this is kind of the much more interesting scenario. Now, I don't know how this potentially plays out if we do have this scenario, whether it's an abrupt, show of the hand, or if it's a lot more kind of subtle, right? So it's kind of like patriotism, U.S. companies not getting bids, Chinese companies boycotting U.S. kind of companies in China, and it could also be outright the other way around, i.e., sans China losing its Macau license, GM and Ford told to pack up and leave, Apple told kind of the same way, right? This, I think, could get very, very kind of interesting. And again, if I was consigliere to Xi, I would also say, well, you have arrived, you are a world power, but maybe it's time to start asserting that world power globally. And I would open trade relations with Iran, Venezuela. I mean, all of these things that Russia is so good at doing is a way that China could actually also turn around and kind of play this kind of hardball scenario. So I would not be surprised to also see more strikes or launches, I guess I should say, to be more precise, from North Korea, again showcasing that this is a lot more of a complicated situation than just trade data imbalances that Trump kind of seems to have. So this is something that's very, very interesting. I will also note that it's definitely something we've not seen from the party and the administration. China's generally been very, very good with not getting involved in other affairs such as, let's say, Iran or Venezuela, or at least on the levels of the U.S. And Russia. But I'm trying to say that this is definitely another kind of big pivot that they could make. And it's a big one because it would be structurally just changing things and, depending on how you want to see it, potentially dividing up parts of the world. Now, again, depending on how this breaks out, this could be a scenario that would shadow basically fourth quarter 18. In this kind of scenario, I can't see Chinese equities surviving, but again, for them, it's potentially short-term pain for long-term gain of being not held over the barrel or anybody else for that matter having a say in their destiny from, let's say, like the U.S. I would see massive new lows in bond yields globally. Gold getting a bid off of the back of that. U.S. dollar, as we know, has tended to do quite well when we have kind of massive kind of risk off. And generally, I'd see equities lower. Probably still see a case of U.S. outperforming versus the rest of the world, just from a relative speaking. And then I think I'd be super short, though, a segment of the U.S., which would be basically the semis, likes of the chip kind of makers, especially given the fact that Apple used to get about 20% off the top of my head, I think, kind of, rev out of China. So you can also imagine the sales kind of going down kind of there. So this to me is, I think, a lot more of interesting stuff in regards to kind of significant greater kind of downside that we could get, and definitely something that's worth kind of keeping on radar, so to speak. So that's kind of U.S.-China. That's very live, very kind of dynamic. But I guess the long and short of it is, I could be wrong, and maybe there's just so much liquidity out there. It's always just kind of buy the dip, and China will kind of come to the table and take it because they're playing the long-term game, and they realize perhaps Trump is not here in a little bit under, I guess, a year and a half. And I'm just missing something, or things are just a lot worse than we kind of know, or it could be just as I still think that it's going to get a lot worse before it gets a lot better, and the things that have lagged in the sense of outperforming, such as likes of SPY, oil, etc., could actually have quite a bit of a big move kind of lower. Touching on a few other things to mix it up, we are seeing here, this is Uber IPO. So this was obviously, this part of the slide in here was what was discussed on basically Friday, which was obviously Uber, as everyone kind of knows, everyone's probably used one that's on this call, has probably been the most famously watched unicorn out there. Maybe the only other one I can think of that's maybe at these levels is Airbnb, but that's a very, very different business. But this has kind of been something where also a lot of people have been calling that the day Uber lists will probably mark the high of the market, similar to stuff where we had with Blackstone many years back, as well as the likes of Glencore, as well on kind of the commodities kind of side of things. What has been interesting is Lyft, which basically beat Uber to listing, had a 77 strike. We're actually down since then about 34%, given a further kind of big decline on Friday. And Uber's DBOT was closing at 41.57, south of its 45 strike, which is basically towards kind of the lower end of kind of the range, down about 7.6%. I think the key thing to bear in mind on all kinds of recent IPOs, generally speaking, especially if you have a weak kind of market, they tend to be the weakest kind of hands out there. What I think you should watch out for is that they tend to have this 6-month kind of lockup. So the only part I'd start to get interested in these companies, at least from the long side, is if we're on the other side of that 6-month lockup, and again, just look that up, but that tends to be kind of the view, and maybe if we've had like a 50% kind of pullback from some of the highs or from the IPO kind of strike. So I'm thinking, like, remember the likes of Facebook, the likes of kind of Snap, and so on, potentially kind of here. I think at one point they do make money, but I think that could be like 5-10 years from now, which of course doesn't mean that they will not be up at some point in that kind of 5 to 10 years. The other point I was flagging out on the traders lunch that we had on Friday was this new IPO also recently, which to me is just phenomenal. If you've not already heard about this, I'll just kind of touch on it briefly. This is the epitome of big global macro kind of trends. Everyone should be putting this on their radar, in my very, very humble opinion. So this is called Beyond Meat. It IPO'd. It's got a competitor that I think is called Impossible. You may have heard of something called the Impossible Burger. Now, in essence, what they are doing is they're creating plant-based protein food products that taste like meat, have the texture of meat, even smelling similar to that. I actually tried this last week with some friends over lunch, a few other kind of macro guys, family office guys, and traders. And I'm telling you, being a big carnivore, you literally cannot tell. So just to kind of give you kind of context, Beyond Meat IPO'd, I believe it was priced on the 1st of May, IPO'd on 2nd. It actually popped up 168% on the first day, but that's not really the key thing here. As I said, this is big term kind of trend. It has a market cap of about $4 billion. Tyson's Foods, which is one of the biggest meat producers in the world, has a market cap of $30 billion. So that's just 6x, right? But I think what is really crazy here is from a long-term kind of perspective. This is not, I think, just the cannibalization of people who eat beef, lamb, chicken, fish, but I think it overlooks also people on the planet who are just predominantly vegetarian, either due to kind of economics or also just religious and kind of cultural beliefs. And it is also possible is at least my understanding that you can also get it cheaper than actual beef, and it is less unhealthy than actual kind of beef. And of course, from a carbon footprint perspective, it's also very much kind of the way forward. Last thing to just kind of keep in mind here, or two last things. Again, key risk I think here is obviously execution risk, just from a business perspective, from actual kind of management. I don't think competitors any kind of a big deal at this moment. I think the meta takeaway here is they have less than 1% of the global kind of meat production industry. And just to give you guys context and Gerald's context, global meat, poultry, and seafood market is expected to exceed $7.3 trillion by 2025. So this to me is like one of those kind of shelf trades where you totally ignore valuation, you pick it up, you put it on the shelf, and you open it up about 5-10 years from now. And we'll either be thanking KVP or cussing me out. But, food for thought. I think this is really, really fascinating. Do some work on it when the research pieces start coming out. It's one of those where I just think has infinite upside, and it's definitely not something I'd be shorting, even though I do know quite a few hedge fund guys out there have been doing it. But I mean, this is very kind of strategic and long-term in discussion, not tactical at all. Obviously, that was a massive pop-up on the first day, and it's also worth noticing that the last few sessions on Beyond Meat have been to the downside. So we'll get a look at quite a few charts shortly, but I'm just going to bring in my colleague Forrest, who's going to give us some views on CNH, and then after that I may ask him just a question or two on just some local color in regards to kind of potential China response and maybe what we could expect to kind of see from the media there. So
Hello. Hello everyone. Thank you, Kay, for introducing me. Good morning, everyone. This is Forrest from Saxo sales training team in Shanghai. So before we start, I need to disclaim that this is no Saxo house view and does not make any recommendation. Today, I want to share some updates on $CNH spot, which had a big move last week with US-China trade talk driving the global markets. And $CNH spot is actually the most direct instrument to gauge and trade this risk event. So how do I look at right now? With the slides. Okay, can you help me move forward the slide? Okay. So let's have a quick recap in case you are not familiar with this pair. So $CNH spot in recent year had gone through two stages, which are downward channel and range bound. So please note this is against the backdrop of strong dollar index creating new highs, which means CNH is actually much stronger than Euro and other pairs. And it's actually the best performer in Asia space before last week, where the Korea won is the weakest, so making the CNH Korea won the best trade of the year in Asia. Currently, it has broken 6.75 and 6.82 key resistance. So next $1 million question is, will it keep trending up or in a new range? My answer is that we need to look at it in different time frames. So in the short term, it's much likely the trend will keep going up considering the ongoing market sentiment and the technical breakout. Please note the S&P 500 futures this morning has opened down 1% and the 50 futures also opened down 2% this morning. In the midterm, I don't see the trend will go another leg higher. I would much like see they will go to a new range, mainly because of the balanced macro. It doesn't support $CNH keep trending higher, as we are already seeing the economic activity is keeping going up in China. So what else do we need to consider? Next click page for the first slide. Yeah. So what else do we need to consider? There are some onshore factors that make $CNH spot difficult to trade. And we have $CNY fixing published by Central Bank PBOC. The key features of fixing is very simple, I will say. So during the range market, the fixing is actually the anchoring point. As you can see from the bottom right chart, during the range bound time period, the fixing highlighted by the green line is actually the centerpiece of the range. But when the market started trending, the fixing is actually acting like a decelerating factor. This is actually very useful for trading perspective. For example, in the recent trending market, the fixing decelerated the speed, okay? And the traders or the trend followers, they have enough time and the price base to get on board. And also, we observe the widening onshore spread, the spread between $CNH and $CNY. It's widening, which means the onshore interbank traders, they are reluctant to chase spot higher. Also, I discussed with some interbank traders because there are some non-market factors behind, but ultimately it's the market force that drive the spot direction. So all in all, I will say the spot is going to trend up in the short term, but in the midterm it will range bound. Yeah, that's it for the $CNH part.
Great. Now, Forrest, we were chatting a little bit over the weekend, and I was just trying to get a sense from you on what do you expect is the consensus response from China to, the latest salvo from Friday. Do you think it's going to be measured? Do you think it's going to be maybe surprising one way or another? What's your view in regards to the different clients that we speak to down there, our corporate kind of network, etc.?
Okay, so before declaring my own personal view, let's look at the fact, right? So the Chinese government said last week it would respond to Mr. Trump's move with new tariff of its own. But so far, we are not seeing any action yet. So it's relatively measured and calm, as you have mentioned. And this is because China still believes a deal could still be made, right? Here I want to share some my personal view of how to look at the US-China relationship before we draw any conclusion. For me, US-China relationship is like a marriage. China is acting like a husband who is patient like a gentleman with 5,000 years history. And US, for me, is acting like a wife, always crying out loud for something, complaining to media and complaining to her neighborhood. They may quarrel, but they want this divorce with much common interest and bondage, much like they have given birth to dozens of children. No offense here, I just want to make complex things easier to understand, and it's helpful to understand what's endgame like. What is endgame? I feel like they will have a deal made between each other ultimately. So that's why I agree with Kay that the high probability case is kiss and make up.
All right, fantastic, Forrest. Thanks so much. All right, great. We'll catch up with you again next week, and maybe even during the week if something else kind of comes through. But otherwise, keep us in the loop, bud. All right. Okay, so that's $CNH, and just to follow up on Forrest, I'm gonna include a few yuan kind of charts. Just to kind of for the context, this obviously is just a weekly chart on what was just kind of being showed. You're obviously seeing that kind of clear breakaway. So this was all during the talks and everything kind of going well. We got to about 670s, some low, high 660s. And we'd actually talked about this 680, 685 in quick succession if we started to get a little bit of kind of volatility here, and we definitely are. This is definitely another barometer, I think, in my viewpoint, of how well the talks are going. It's still very possible for us to get above 695, in my viewpoint. A big breakaway would be above kind of 7. This is a very nice way of China to still, quote unquote, give the U.S. what it wants without for the full effects. I saw a very interesting piece from Citibank strategist, and his basically view was if you take the yuan depreciation into account, then actually the effect of the tariffs is still net positive to China, right? By a tune of something like 35 billion, which is quite interesting from a math perspective. And again, this is also just something that most people, it's one of those kind of tacit taxes, if you will. So this is again another way of China potentially still maybe giving the U.S. what it wants, and maybe actually still allowing the yuan to kind of go up. Maybe that will be the compromise, right? And then everyone can kind of save face and look like they got something for their respective teams. I think very hard for me, at least right now, to envision a scenario where we kind of come back and go through kind of 670. So yes, we've had a big move up, no doubt about that. But I still think the convexity right now is to the upside. So definitely worth keeping that in mind. So this here is Aussie versus CNH. Obviously, this has been kind of fantastic for Oz when it's weakening versus its biggest kind of trading kind of partner. But notice what's happening over the last week. Big reversal higher. And this is with a very weak Australian dollar, as we know. And potentially that breaking up higher is not going to be, I think, conducive or constructive for Australian equities. This is gold and CNH. Again, the breakout kind of higher there. Potentially we could be challenging kind of 9,000 if things are to get kind of worse. Also have the MACD about to kind of cross up higher. RSIs also indicating kind of constructiveness. This here is actually something that's really fascinating to me. This here is now the HSCEI, and what I've done here is I've taken the inverse of dollar CNH, right? So basically this is CNH USD, so this means the yuan is strengthening versus the dollar. This means it's the other way. It's the yuan weakening versus the dollar. So obviously this is the period of the trade negotiations, all going good, fantastic. This is obviously post-Trump's tweet. So you can basically see that there's a pretty clear relationship between the movements in HSCEI, and I believe I saw an R squared of something close to kind of 80%, and where the yuan is going. So this is another kind of proxy play, maybe for those of you that don't have a mandate on the currency kind of side, only have an equity mandate, or vice versa, or maybe you're looking for a hedge. Do check this one out. What it does say is potentially a move to 10,000 is very doable. With if we still have a lot of kind of pressure there. Also beautiful kind of cross down on the MACD, RSI there. Moving on, this is kind of the same idea, but here in essence I've done it with the AS51, so Australian kind of equities. You can see the relationship is nowhere near as sweet as in the previous kind of slide, but there definitely does still seem to be some kind of contention in regards to kind of the moves. Just doesn't seem to happen as kind of quickly. There seems to be a little bit more of a lag, which maybe makes sense if it's about goods, because obviously by the time you ship out the goods and by the time they kind of go out, can take a few weeks to kind of a few months to see that kind of effect kind of come through. But what this may again indicate is maybe back end of second quarter, or maybe in a few weeks kind of time, that much more kind of pressure from ASX kind of coming home to roost. Obviously, there's a few more moving parts with Australia, as we know. A lot of domestic issues, housing market issues, and an anticipated cut or two from the RBA later on this year, and a market that's been very well bid. This here is E-minis, just S&P futures weekly, showing you kind of maybe scope of potential kind of move. I still think 2,700 is still kind of very kind of doable, and of course 2,800 should be no issues at all, so to speak, but that starts to get towards kind of the 20-week kind of moving average. Have a MACD potentially kind of crossing down. Obviously anything you're doing here for a move to kind of 2,700 or even which is basically around here, you'd need to kind of have a high off of a stop, which is kind of close to recent highs. This here is ASX again, futures, again, just showing you just how well up it's been holding up just amazing in my view. I think we should be well sub of 6,200, heading towards 6,100 to 6,000. I think that's only kind of a matter of time. So far I've been wrong, but let's see. And this here is a CSI 300 massive rally, as we all know. I think got up to about 30%, and this is the big pullback from last week. I'd expect much further downside and pressure here if my thesis plays out of a lot more. It gets worse before it kind of gets better. So more volatility before the kiss and make up. And if we go hardball, then this is definitely going back. At least from a high probability perspective, in my view, close back to kind of 3,000. Beautiful kind of cross the back looks of the MACD, RSI kind of pointing lower. This is definitely something I'd be more prepared to play on the shorts kind of side skew. Nikkei still, decent kind of pullback, but I think potentially further downside again also possible. Nowhere near as clear cut in regards to kind of potential as some of the others, so to speak. This year's Aussie yen. I would expect breakdown to kind of new lows. I'm kind of ignoring this liquidity event that we kind of had early kind of Jan, so to speak, because it wasn't really a close figure. But I don't think 75 is unrealistic if we start to kind of get worse. This here is gold. Potentially 1,300. Again, watch yields, don't watch USD. So if yields keeps on breaking down lower, we will kind of move back. And everything we're covering around, obviously, if we get a clear resolution, they sign the deal, we're basically doing the reverse of all of these, right? So in that case like that, then obviously you're long your Aussie yen and you're long your Kiwi yen and so on and so forth. But until I think that cloud kind of clears up, I think the momentum is still very much kind of towards the downside. Dollar yen again also very well behaved in my viewpoint. I was surprised we were not south of 110 already that kind of Monday when the tweet kind of broke. Here again, as we were talking about 105 to kind of 108, kind of felt right as a zone to kind of get into. And with that, brings us kind of towards the end of this week. Let me wish everyone a very good luck and profitable week up ahead. And I will be shortly opening it up to comments, questions, and